Hello and welcome to the Olson and Bird weekly webinar series conference call, Making the Most of Tax Reform. Today's session is Outbound Case Studies. As a reminder, today's program is being recorded. At this time, I would like to turn the conference over to Mr. Scott Harty. Please go ahead, sir.
Thank you. Good morning, everyone. Thank you for joining us again. Again, my name is Scott Harty. I'm a partner in the Federal and International Tax Group here with Olson & Bird. And this morning I'm joined by my partner, Sam Kaywood. This week we're going to be looking at some outbound case studies, and we're going to be touching in particular on a few issues, including GILTI and some M&A topics. Sam's also going to join us next week to address some anti-hybrid provisions under 267 Cap A and 245 Cap A. So a little bit of preview for next week. Yeah, just so you're aware, a little bit of housekeeping, we are going to be expanding the series, and we're going to offer some benefit-related presentations that may be of interest to you, as well as a few other domestic and international topics. And if there is a topic that may be of interest that maybe we haven't touched on that you would like to hear more about, please feel free to email us, and perhaps we can include that in the lineup. And then once again, the prior presentations are on our website, so you can listen to those if you've missed any, and we do post the slides as well, so you can access all that information. So today we're going to touch on a variety of topics in the outbound context. As always, we do welcome questions. So if you'd like to raise a question, please submit those at any time during the call, and we will do our best to answer them. If we can't answer the question during the call, you will definitely get a response from us afterwards. So you can just type the question in on your screen, and Sam and I will see that pop up. Other participants cannot see it. So we're going to do our best to stay within our 30-minute window, and let's go ahead and get started. Let me do just a quick introduction. Sam is a partner here in the Atlanta office. He concentrates on federal income and international tax matters, including cross-border M&A and joint ventures. He has particular experience in Canada, Europe, China, and Latin America, and is active in structuring investments in Latin America. And he's a frequent speaker and author on a variety of international topics. So we are thankful to have you, Sam, and I will turn it over to you now. Thanks.
Okay. Thank you, Scott. So hello, good morning, everyone. So this presentation comes out of a panel that I chaired at the ABA tax section in New Orleans just last month. And so due credit goes to the other panelists who prepared many of these slides. Barbara Rausch at KPMG, former IRS Associate Chief Counsel Office, Natan Leia, and Rafi Mutahad, I can't pronounce his name, but he's with Cargill and was very knowledgeable. So moving forward, what we're going to do is we're going to cover sort of a selection of these topics. We're going to start with the basketing of interest. So let's take this scenario. We have U.S. company that owns a foreign holdco, and foreign holdco owns CFC. 100% of CFC, and CFC has income that would be GILTI, basically GILTI income, not much in the way of passive basket or general basket income. But let's say it's a service company, it's a internet company, software company, very little Q-buy, and it's paying interest back to the U.S. on a loan. Now, in the old days, before tax reform, we had these loan valves, and the idea behind the loan valves back then was if you lent money to your CFCs to do acquisitions and things like that, then you could pull profits out by way of paying back principal, and you might have a low interest rate on the loan. This was thought to be a good thing, but after tax reform, it puts you into an interesting situation. First of all, the interest itself is the interest income is taxable at 21%. It's interest received by a U.S. company. The interest deduction at the level of the CFC on one hand, it reduces GILTI because it's a deduction, but on the other hand, it increases GILTI because interest paid outside the CFC group reduces the DTIR, the deemed tangible income return, which is the good income on the QBI. So the interest that is paid basically increases your GILTI inclusion. Well, what happens to that inclusion on the U.S. return? What basket is it? Now, here's sort of the point of this, that one would think that if interest is paid out of a CFC that has mostly GILTI income, that under some sort of a look-through rule, that the interest would be characterized as GILTI basket income. And in my case study here, I'm more or less assuming that USCO has excess credits or will have excess credits in the GILTI basket. It doesn't work out that way. The proposed regulations basically say on the basketing of the interest income, you've got two choices. You could either basket it as passive if it's allocable to passive income. In my example, I've said no, it would be GILTI income. It wouldn't be allocable to passive income. Or it's general basket. So it would default under the proposed reg to the general basket, even though in this example there really isn't any general basket income. And so you're a little bit at a loss, because what you want is you would love to have that interest characterized as GILTI basket income. Now, in some cases, now there are going to be taxpayers with excess credits in the general basket, and they may want the interest to be characterized as general basket income, and that could be favorable. So this rule, this proposed reg, could be a good thing, or in the case of one client of ours, was a bad thing, and was a bit of a struggle for us. So one possibility is the next slide, which is to contribute the loan into a holdco. So if we're not going to get a foreign tax credit benefit for the interest, it's going to be in the general basket, when what we really want is GILTI basket income. Well, then if we drop it into foreign holdco in this example, we get interesting results. We basically avoid the tax on the 21% tax on the interest, because the interest now, on one hand, it increases tested income at the level of foreign holdco, but on the other hand, it does not reduce the deemed tangible income return. That's the good income, the 10% of QBI. So the net result to GILTI income is a wash. There's no impact on GILTI. Tested income goes up, but the reduction of the good income, deemed tangible income return, goes down. It's a net wash on GILTI, but lo and behold, no interest income on the U.S. return. Therefore, you've eliminated the 21% tax that you were not able to shelter by having the income in the GILTI basket. Now, there are going to be some issues here. You're going to worry a little bit about withholding tax in the CFC jurisdiction. You have to be careful about that. It may take treaty planning because of BEPS and things like ATAD2, the changes going on in Europe. It may not be easy to shelter the interest income in foreign holdco. Maybe foreign holdco might be in Barbados or in Bermuda or someplace like that. And anyhow, those things have to be looked at. Other things to look at are, whether the CFC itself gets a deduction for the interest, based upon the new limitations on 30% of EBITDA. Europe now has something like our 163J. So a lot to look at here, but as a general matter, this is sort of an interesting one to to consider. So we're going to skip over the next set of slides. Okay, and let's talk about the next set of slides deals with the new 904B4 rule and its potential impact on OFLs and ODLs. But let's move over to another topic that I think some of you on the phone are giving some attention to, and that is the affirmative use of Subpart F. So posit the situation where you have an overall foreign loss here in the United States, or you otherwise have high allocations of interest expense and other expenses against GILTI income, and you're somewhat high taxed in the foreign jurisdiction, so that what you end up with is you end up with GILTI income from your CFCs. You do have a lot of foreign tax credits, but you can't use them, or you can't use a significant portion of them because of OFL and expense allocations. So you say to yourself, well, gee whiz, you know, I would love to have zero tax on this income. How can we get there? Well, there's an exception to the GILTI rules. The exception applies to income that is kicked out of Subpart F because of the high tax exception under 954B4. Now, there is no high tax, just to be clear on this, there is no high tax exception for GILTI income. This has to be income that would be Subpart F income, but wasn't, because was excluded because of the high tax exception. So the high tax exception now runs at an effective rate of 18.9%. That's 90% of 21%. The foreign effective rate is at least 18.9%. Then this income may qualify for this exception from GILTI. Now, the impact of that is that the income would be kicked out of GILTI. It's kicked out of Subpart F at the same time, which means it's just not taxed immediately. It then goes into the bucket of E&P, untaxed E&P, that eventually could be distributed with a DRD under Section 245, Cap A. So this would basically get you down to a pure territorial, pure zero tax result on this income, and so you know, there are other aspects of this. I mean, you know, GILTI income, you have no foreign. You either use your foreign tax credit or you lose it, and so even Subpart F income, if the high tax exception didn't work out, Subpart F income would give you general basket income. It might give you more flexibility on using general basket foreign tax credits, and that might be a good answer. So just going over to the next slide. Okay, so a few other things about this high tax exception. So if you're able to kick out the income such that it's not GILTI income and not Subpart F income, that will reduce your reliance on foreign tax credits, which could actually reduce your BEAT. Some of you may be in the BEAT or may be close to the BEAT. Well, the BEAT is a minimum tax that compares this proposed minimum tax against your regular tax. Foreign tax credits reduce your regular tax for BEAT purposes and could throw you into the BEAT. So there might be some thinking to do about whether you prefer having GILTI income and foreign tax credits, or perhaps you prefer to kick out the income so that it's not taxed under GILTI and you're not using foreign tax credits and your regular tax is higher, thus having less beat. So that's something to consider. The high tax exception has to be elected, so it's an affirmative election made on the return, and there are, there's a good bit to think about there. Okay. Now, the high tax exception, if you go down that path, there's a lot of granularity there. There's groupings that have to be made, and the tax has to be associated with specific groupings. So there's a separate grouping for foreign-based company sales income, a separate grouping for foreign-based company services income, although to be used generally can be averaged if they're in the same bucket of foreign-based company sales or foreign-based company services. So let's just roll on a little bit. Okay, so then the question is, okay, fine. How does one convert GILTI into Subpart F income? Well, you have to have Subpart F income. We've spent the last 3 decades working to avoid Subpart F income. So how does one do that? Well, you would be thinking about check-the-box type structures. Here we have, we're trying to opt into foreign-based company services income, and we have CFC1 in country A, CFC2 in country B. It had a third CFC in country C. If we check the box on the third CFC, down there, service provider, if we check the box on that entity to make it a DRE, then what you have is you have CFC2 providing services to CFC1 outside of its country of incorporation, and that would get you into foreign-based company services income, which would give you Subpart F income. If the income is high taxed, you're kicked out and you don't have either Subpart F income or GILTI income. Similar concept here on trying to plan your way into foreign-based company sales income. So that's that. So let me move on. Okay, there are a series of slides here on sort of branch versus subsidiary. In the interest of time, I'm just going to give you the upshot of these slides, sort of where I'm at on the whole idea of would I prefer, if I set up a new business, a new foreign business, would I prefer it to be in a CFC or would I prefer it to be in a branch? So you may know that that branches now have a separate basket that we would have the branch basket, which would be kept separate from the GILTI basket, and the branch income would be taxed immediately in the U.S. at 21%, and then we would try to take a credit for the foreign taxes paid. You could be in a branch either by having a real branch or you could have a foreign company that is checked as a DRE so that it's treated as a branch for U.S. purposes. Well, I'll just give you some reflections on this. It's not necessarily technical analysis, but some reflections, which is because the Treasury and Congress have now made it hard to flip the switch to go into a CFC, Congress repealed the active trader business exception under 367. Even before they did that, the Treasury significantly curtailed the ability to move your foreign branch into a CFC on a tax-free basis. They basically said that the transfer of goodwill into a CFC and a 351 transaction, that would be now taxed under 367. So the ability to flip the switch from a branch to a CFC is basically not easily done, or at least not done without significant tax consequences to consider. So I am of the view, all things being equal, there will always be numerical cases that will support, one situation versus another, and that could mean that a branch is better. But I'm generally of the view that we should be keeping our IP offshore. We would not be onshoring our CFCs and our IP and our CFCs. We would keep them in the CFC format, and our new foreign operations would be organized in CFCs, and where possible, push IP offshore. Now, it just sort of comes from the fact that I'm a bit of a suspicious guy, right? If we have a different political party in power, they might easily decide to, or even this party, who knows? They might easily decide to increase the corporate rate. 21% does seem low by developed country standards, and so if they increase it to 25%, then you might still prefer to be in a GILTI environment at half the U.S. rate or not. Now, there are other schools of thought on that. I mean, if we had a party that felt like corporate America got too much of a benefit under the tax reform bill, they might repeal Section 250. Section 250 gives us a half tax rate effectively on GILTI income. And so in that case, if they increase the corporate rate and repeal Section 250, then we have it wouldn't matter whether it was in a CFC. But my thinking, and I think the thinking of others here at Alston and Bird, is that we're still better off to work in a CFC environment if we can. So skipping through quite a bit, I wanted to talk a little bit about a few M&A scenarios. So here we have a fairly typical. I think I do have a question. I assumed this is on one of the earlier slides, so I'll deal with this question by email. So here we are on a U.S. seller, corporate seller, with a CFC that is a target. So we're selling the shares of a CFC to a buyer. For this purpose, it doesn't really matter if the buyer is U.S. or foreign. Now, I've assumed in this example that there's zero basis inside the target CFC in assets, and the assets have a value of $1,000, and we're going to sell the shares of the CFC for $1,000. Assume no outside basis. So that seller sells shares of target for $1,000 and has gain of $1,000. Now, further assume that, well, we just had our 965 tax. We've got lots of PTI in target, or maybe we have none. Either way, it doesn't matter. But we don't have untaxed E&P because we had all of it was included, or most of it was included under 965. Well, in this case, think about what happens if we do a 338 election. If we ask the buyer to do a 338 election, if I don't have a 338 election, we sell the shares of target. Seller has a gain. It's going to be of $1,000. It'll all be residual gain. None of it will be recharacterized as a 1248 dividend because, in my example, there's not much or no untaxed E&P. If we did have a dividend, some untaxed E&P, that would be a good thing because the amount we characterized under Section 1248 as a dividend would be subject to a DRD. There would be no U.S. tax on the 1248 piece. So that's one thing to bear in mind. In this example, I'm saying, well, there wouldn't be much E&P that is untaxed, so the 1248 piece is small or zero, in which case the DRD is small or zero. What the 338G election does is it converts an outside gain into an inside gain at the level of the CFC. So there's a deemed sale of assets, and in that deemed sale of assets, there's a gain inside the CFC that would give rise to GILTI income. And you would get, as a corporate seller under Section 250, you would get a 50% deduction against that GILTI income. And so you've converted what would be a residual tax at 21% on the gain on the sale of these shares into GILTI, taxable effectively at 10.5%. All subject to foreign tax credits, so on and so forth. So this is generally a good thing. You might be in a situation where you go to the buyer and you say, hey, we would really like for you to make a 338G election. And so we're going to actually require you to do that in the contract. And so that, you might get a quizzical buyer who says, why am I doing this? Well, you should be able to, if it's a U.S. buyer, the buyer will generally want to do a 338G election anyway, so it should work out fine. For this audience, we don't talk too much about individuals. This is mostly a corporate audience, but I think this is just something that everyone should know. If we had a U.S. individual selling the shares of Target, then a 338 election could be devastating. So here, same facts. We have a lot of outside gain. If a U.S. individual sells shares of a CFC without a 338G election, the gain will be capital gain, taxable at 23.8%. So that's not a bad rate. If there is any untaxed E&P under 1248, it would be taxed at the dividend rate. Assuming a qualified foreign corporation, it would be, again, 23.8%. So not a bad answer. However, if the buyer makes a 338G election, then the inside gain is triggered, and that gives rise to GILTI income. GILTI income would be taxed to the individual at 40.8%, a really bad answer, almost double. And so this would have to be dealt with in the contract to avoid this kind of a very bad result. So I want to finish up with one slide, and this has to do with the 965 tax and the gross up on the 965 one-time inclusion. So a lot of our clients have November 30, and in my example here I put a June 30 fiscal year end, so that the one-time tax on foreign earnings under 965, that would have occurred, let's say in this example, the inclusion would occur on June 30 of 2018. And let's say that there was a fair amount of foreign tax credits inside the CFC. There was a pool there of foreign tax credits, and those were included under Section 78. So let me just deal with this. So normally what you would do is you would say, okay, if I had 100 of 965 income, and I had, let's say, a gross up of 20, I would add the 20 to my 100 of income, and my total inclusion would be 120, and then I would take the tax credits from there. Well, there's a little bit of a glitch on the interaction of the old Section 78 and the new Section 245A, the new DRD. The new DRD, absent a fix or a change or something, the new DRD would apply to this gross up of the foreign tax credits that would occur on June 30 of 2018. This would only work for a fiscal year CFC. If a CFC had a year end of 12/31, then the DRD was not yet applicable at that time. And so this is a bit of an opportunity for those who are, not faint of heart, shall I say. So that the gross up, basically, you can take a DRD for the gross up. There's a proposed reg to fix this, but the thinking is, and certainly our thinking is, that the statute not only permits this but requires this perhaps unintended benefit. The proposed regulation is likely invalid, and we have one client we're giving an opinion. Some of you are probably already aware of this. It's been talked about. Technical corrections would fix it. It's a question of how you handicap whether technical corrections and when technical corrections would get passed. We've seen at least one accounting firm tell their client that they should book the benefit unless they intend not to litigate. So this is I've seen different results from different accounting firms on what to do about this, but it's definitely gotten some attention. So just a little bit about next week. Thank you for listening in on this. A little bit about next week. I'll be talking about the anti-hybrid rules, both in the inbound and outbound context. And I'm also working with the ABA tax section to write comments on the anti-hybrid rules, the proposed regulations. If you've got thoughts that you would like us to consider including in our comment letter to the Treasury, you can email us. You can email those to me before or after we do the program next Tuesday. But anyway, thank you all for listening, and I'll hand it back to Scott.
Thank you, Sam. That was great. I think if we've seen anything through this series, that there's a lot to digest in all of this. We look forward to next week. And once again, if you do have questions, you didn't get them, feel free to email us. We're happy to think through some of the issues you're facing. And also, if there are topics, feel free to let us know. I think certainly we could cover M&A issues, GILTI issues in more detail, or the PTI rules that recently came out. There's a lot of other topics that we can address and might add to this series. Once again, the slides should be available for download as well as the audio soon, and we thank you all for joining. We appreciate your participation. We hope this has been helpful, and we look forward to seeing you next week. Thank you.
Ladies and gentlemen, this concludes today's webinar. Thank you for your participation. You may now disconnect.